इवन आप कोई मतलब अनरिलेटेड एग्जांपल भी ले लो, न्यूज़पेपर में कभी कुछ आता है ना, एक्सीडेंट हो गया।
वो मेरे साथ नहीं होगा।
I want to say something to you, but allow me to clarify first. I wouldn't wish it on my worst enemy, yet I feel I have to say these words because words are powerful. Your parents will die. Your loved ones will get hospitalized. You are not immune to accidents and you were never born special. Whatever can happen will happen. It's Murphy's Law. What I mean is, do not wait for something bad to happen to finally get the motivation to prepare for life. This is a story of a physicist who studied 14 more years after school to finally land his first job. A physicist who never imagined something like this would ever happen in his family. This is the story of Dr. M. Pattabiraman, also known as Pattu.
Hi, I'm Pattu from FreeFinCal. Vanakkam and pair Pattu. Simple thumb rule for retirement planning.
True wealth has nothing to do with money, but I told myself I'm never going to be in that position again.
Pattu is a professor of physics at IIT Madras who started learning personal finance out of fear. His interest in the field of finance and his background as a researcher allowed him to dive deep into it. In 2012, he launched his website called FreeFinCal.com, short for Free Financial Calculators. Pattu has developed several smart financial calculators that are used by not only common people but also used by SEBI registered financial planners. His flagship product is the Robo Advisory Template that helps anyone build their financial plan for retirement in a smart Excel sheet. He also teaches personal finance through his in-depth data-driven research articles and his YouTube videos. And as a matter of fact, I personally learned majority of my personal finance lessons from his content. And finally, I'm traveling to Chennai.
यहाँ ब्यूटीफुल सनसेट हो रहा है एंड हम अभी यहाँ से निकल के चेन्नई जाएंगे पट्टू सर के साथ पॉडकास्ट करने.
To meet him and talk to him about life, investing, about the mistakes that we make unknowingly that have huge repercussions and how can we successfully build wealth. It is truly an honor and a privilege to be able to do this with him.
So we are in Chennai now and tomorrow we have the shoot with Pattu sir.
तो ये हमारा बहुत सबसे डिफ़िकल्ट शूट होने वाला है क्योंकि नंबर 1, हम चेन्नई में अभी 11:30 हो रही है रात की, अभी तो होटल पहुँचे भी नहीं हैं. होटल पहुँचने के बाद सुबह 8:30 बजे वी हैव टू बी एट अ कैफ़े. अब ये कैफ़े हमने बहुत ही मुश्किल से ढूंढ के बुक किया है. ऐसा कैफ़े जहाँ पर हम पॉडकास्ट शूट कर सकते हैं, एम्बियंस थोड़ा अच्छा है, कुछ बोर्ड गेम्स हैं एंड बुक्स हैं, तो इट्स नॉट जस्ट अ कैफ़े जहाँ पे लोग खाना खाने जाते हैं. तो थोड़ा वो सोफिस्टिकेटेड नॉट तो थोड़ा वैसा इंटेलेक्चुअल वाइब आता है उस कैफ़े से.
I have never met a person who is more simple and down to earth than Pattu sir. He prefers we call him Pattu, but it's taking a little getting used to.
पट्टू सर आ गए हैं एंड टाइम के एकदम पक्के हैं, तो हमारी बेइज्जती नहीं हुई है. वो भी टाइम पे थे और हमने भी जो टाइम सोचा था हम उस टाइम पे थे.
Hi sir, I was here a few minutes ago. I didn't realize you were upstairs.
Hello sir.
Hello.
Before we proceed, a necessary disclaimer. ये podcast English में है because Hindi is not Pattu's first language. However, इसके subtitles जल्दी आ जाएंगे. This is Money Minded Mandeep. Welcome back to Jagruk Talks Season 2 Episode 5 powered by CRED. Let's listen to the conversation.
So firstly, I'd like to ask you, you are a physicist, you teach at IIT Madras. What was your childhood like? So I'm trying to, understand how did you move from being a physicist, now you're a finance educator. How did it turn out to be?
Yeah, so first of all, thank you for this opportunity.
Pleasure is ours, sir.
So I grew up not too far from here in a big mansion and a huge joint family. In fact, my extended family stays with me in a system of flats even today. So for me, my cousins are my brothers and sisters. I was the only child.
Okay.
I spent a lot of time alone. In fact, I believe that too much socializing is bad for you because it doesn't allow you to become creative. So my parents allowed me to do whatever I wanted to do. I always wanted to do something creative. And physics seemed like a good idea. And they did not have any second thoughts about me doing physics. It was in the early 90s. There were many friends and relatives who said, you have only child, how can you allow him to do physics?
Yeah.
You should get a loan and put him in an engineering college or in a MBBS seat or something like that. But they let me do it. They let me follow my dreams, and one thing led to the other, and I soon became a physicist.
So, what was your early career?
So the path to becoming a physicist is very long. So I finished school in 1992, and I got my full-term job in 2006.
Oh,
so,
okay.
So 3 years of BSc, 2 years of MSc, 5 years of PhD, then a couple of postdoctoral stints, and then you get a job. So it's a long, drawn process.
Okay. So, have you seen a show called Big Bang Theory?
Yes, I have seen snippets of it, not too much.
The main character of that show, Sheldon, is a theoretical physicist.
Yes. It helps kids understand that science is accessible to them.
Yeah.
They can also do what they are doing.
Yeah, exactly. So, after your job, how did you become a professor at IIT Madras?
So, I had these two research stints, one in Germany, one in Indira Gandhi Center of Atomic Research in Kalpakkam. After that, I became an assistant professor in IIT in 2006, and since then I've been there.
Okay. So, how did you get into investing? I mean, you create so much in-depth data-driven content. So, you're probably the only creator that I have seen who believes in data, and other people can feel it, that you've done some research behind it, and you bust a lot of myths around investing. So, how did you find that passion?
Oh, it's a long story. I wouldn't call it a passion. I just did it out of fear. I would say, because I got my first tenured job in the Indira Gandhi Center for Atomic Research in early 2006. 5 days after my first salary, that was my first ever full-time salary, my father's leg broke on its own.
Okay.
Because of he had a rare form of cancer. And then after 1 month, his other leg also broke. So it was like, until that time, I knew nothing about family life, family responsibilities, nothing. I was a head in the clouds guy. All I knew was my lab. I would just come home to sleep.
Oh.
And so I knew nothing about responsibility. Then everything fell on me. So I had to take care of it. I knew nothing about money management, and the hospital bills started piling up. Thankfully, I was married by then, because I had a very nice brother-in-law who gave me an interest-free loan of about, it amounted to 3 lakhs.
Okay.
3 lakhs in 2006 is a lot of money today.
True.
And so I realized that I was doing something wrong. My father had no health insurance, so I ran and got health insurance for my mother.
Yeah.
So that policy still continues to this day.
Okay.
So 3 lakhs in debt, basically that was my net worth, minus 3. I started with that. It came to such a point that, like you see in the movies, my mother actually told me, you can sell my Mangal Sutra if you want to, have money for treatment and so on. I was, because of a technical glitch, I was out of salary for about 3 months.
Okay.
So before I switched jobs.
Yeah.
So it became to such a point that, all the money was just going away. Yeah. Thankfully, I was able to get into IIT, and things stabilized a little bit. Okay. But I told myself, I'm never going to be in that position again, where I am going to be borrowing because I don't have money. And therefore, I started thinking, what is it you need to do?
Yeah.
So first you need to figure out what are the things you need money for. What do you need money for in 3 months, 6 months, 10 months, and so on. It was soon enough. We had a family started, but I didn't realize that we have this first year ceremony, right, for the child. The first birthday is always celebrated big. It's a big, but I did not know that I had to plan for it after the child was born.
Okay.
It was, I realized, in the next 2 months, we are going to have this big birthday coming up. So where am I going to get money from? Yeah. So I told myself, never again. I'm going to plan. I'm going to make sure when I need money, I'm going to have it. And that's how it started. And because math is not it's not scary for me, because I need math for physics. So I started doing the calculations in Excel. When I started doing Excel, I did not even know how to punch 1 + 1 = 2 there. I just learned, and thankfully there are so many good resources available online. There are so many forums you can learn. As long as you know what you want to type in Excel, you can find it. Many people just want to learn Excel. That doesn't work.
Yeah.
You should know what you want to do. Then it works very well. So that's how it.
So, both our careers, Rohan is our editor. He's just 18 right now. And I also started as a video editor. He also started as a video editor. And that's how we learned video editing. We did not have to pay any money to someone, and we just searched on YouTube how to make a cut, how to color grade, how to do so. And that is a very good point, because a lot of people say that we want to learn video editing, so they are always looking for a defined chapter wise course. But sometimes you may not need that. You just need to do one thing, simple thing, and you can figure out the rest later. So that's a very good approach. So while learning investing, I mean, learning investing and learning video editing are two very, very different things, and I feel latter is very difficult. So what are the challenges that you faced? Because you were determined that you won't ever have to find yourself in that situation. But then how much time did it take you to firstly get to that comfortable situation, and what were the challenges? Because you obviously had a science background, you knew math, but investing is a whole different area. So how did you navigate that?
See, first of all, the math and the analytics, they're useful to certain points to understand certain truths about or practicalities about investing, but day-to-day daily investing doesn't need that.
Yeah.
Otherwise, only the super intelligent or super nerdy people will make money. That's thankfully that's not the case. So what I did was I was reading a lot. All I did was I had NPS, so I was one of the first set of government employees who had NPS.
Yeah.
And at that time, the NPS account was not even set up. It was not put into the market. So it was basically held at the employer at earning some 8%. So what I did was that was my only investment.
Okay.
I did not invest anything. So I just learned. The mistake people do is they first invest and then ask questions.
Yeah.
They first do something. I want something for saving tax. So let's just, I want to give some proof to my employer next week. So I'm going to invest something. And that's how the portfolio becomes cluttered. The mistakes start piling up. Thankfully, I did not do that. I didn't do anything. I was just learning. And then I slowly started buying my first mutual fund. In fact, there are two mutual fund offices in this road. HDFC Mutual Fund is right next to us.
Okay.
And there is Sundaram Mutual Fund right in the next street.
Okay.
So I used to come to these offices and buy. I did not even know at that time, aside from my first investment, that you can buy things through a distributor. And at that time, it was the fall, that 2008, the market was falling. I did not know anything about all that. I just started on 1,500 rupees SIP, and slowly it started from there. I would say I didn't do anything but learnt. That time of 6 months, 12 months, where I learnt without doing much helped me not make mistakes, make big mistakes where I could not come out from. I did not buy an LIC policy or that kind of. But the one thing is, I did not have, my father was not around at that time to tell me to do those things. Probably if he had never got sick and if he were alive today, I would not be here. I would have been that guy with only fixed income in my portfolio with 10 LIC policies or whatever. So it's just, I would say, luck. That's how
it's life.
Yeah.
So after you witnessed the 2008 crisis, how did you navigate? Because a lot of people, pull out their money at times like these. So how did you handle that situation?
So first of all, I did not know it. I did not know the market was falling. I never, to this day, thankfully, I don't see the NAV or I don't see the market levels. I just invest. But what I did notice was after the markets fell and then it recovered.
Yeah.
But it recovered in 2009 sometime.
Yeah.
But from 2009 onwards to 2013, late 2013, the market went nowhere. It was just up and down. During that period, I noticed that every day I would log in, my portfolio was always red.
Yeah.
It was always in losses.
Yeah.
So I was wondering what to do. I used to tell this to my wife and mother, and they were scared. They said, "What are you doing? I mean, you're making a big mistake here." But thankfully, I learned to be emotional about retirement. I always tell people that you can't remove emotions from anything. Everything that we do, whether it is science or investing, some emotions are always going to be there.
True.
Right? So it's better to exploit those emotions in your favor. Instead of being emotional about my investments being red all the time, I thought of being emotional about my retirement. I told myself, if I pull out now, I will again find myself in that debt situation I was just a couple of years ago, and I don't want that. I want to build money so that I'm never going to be dependent on anybody ever again. So that helped me through those 5 years of sideways market. For the first 5 years, my returns were zero.
Yeah.
But then suddenly the market picked up.
Yeah.
And I had to learn I looked at my portfolio one day and I thought, what is this? It's too much money. Then I had to learn units place, tens place, and I had to count. And then I realized that every day the market was gaining what I was investing every month.
Yeah.
And then that's when it hit me. That's how equity investing is. You have to keep investing without worrying about when the market is going to move up or not. It will someday. When it changes, your life will change. And then just like that, my life changed.
Yeah. So during the 4 years that 4-5 years the market did not move, a lot of people find it very hard to maintain patience. So do you think being emotional about retirement and remembering your past days made you patient?
Yes, I would say I actually had a very good piece of advice. When I went for my IIT interview, I met my teacher and he asked me how I was. And I told him, sir, my father is sick, I'm in debt. And said, but to be happy that you're getting all these problems when you're young.
Yeah.
I was like, what are you saying? I mean, come on, man. I mean, I'm in trouble and you're telling me to be happy. He said, 10 years later, you will know that you have enough experience to handle problems later very well.
Yeah.
So it is that experience so it's some way it's lucky. I mean, that's how.
Okay, so I've seen your logo, FreeFinCal logo. What is the story behind that logo?
It's really, it's an inverted percentage sign. It's like saying that we can't get rid of our shadow. Yeah. Our shadow is going to always move around with us.
Yeah.
So if just like that, the risk is the shadow of return. Okay. You can't get rid of risk. Yeah. Whatever return you get, whether it's fixed or not fixed, there's always going to be some risk.
Yeah.
So I wanted to have some kind of so the percentage stands for return. Yeah. The inverted percentage is a way of saying you have to look at risks.
Okay. That's all. Okay. So talking about risks, especially during 2009 to 13, obviously sometimes that thought must have crossed your mind ki how much risk am I taking? Yeah, will it ever move up? So how did you manage risk at the initial levels, and how do you manage risk now?
See, thankfully I had some time looking at inflation. Yeah. I was looking at my expenses and I projected my expenses down the line, how much my expenses would increase.
Yeah.
That told me that, look, there's no other way to handle my lifestyle in future or maintain my current lifestyle in future if I don't get a return higher than that, because you have to pay taxes. Yeah. So my entire portfolio has to have a return or a growth rate higher than that of inflation after tax.
Yeah.
So that was the thing that kept telling me, hold on, be patient. And when I look at the past data, and if you look at the Sensex and plot it in, let's say, a logarithmic chart, you can see that there's a step and then there's this flat. Yeah. It's for years and years it's flat and then it moves up. So you don't know when it's going to move. So you have to just wait. So looking at past data has always helped me understand that the future is going to be at least like that.
Yeah.
If not something very different.
True. So are there some people in your life who have influenced you in a great way? They may not be from your field, but they made a turning point in your life.
There are many of them. For example, I had a wonderful teacher, Mrs. Beena Gokhale, in 11th and 12th standard. She taught us English and she made the subject come alive. She taught us so many things about living, loving, hating and so on. And that is when I realized my calling. My calling is to teach. I realized that's when I'll be happy. It doesn't matter what I teach, whether it is physics or finance or the movies of Guru Dutt or whatever it is. The subject doesn't matter. I just like to connect to an audience. She was the one who kind of made me listen to my passion or my calling, I should say. Then there have been so many people in finance as well. One is P.V. Subramaniam of subramani.com. Yeah. So he has been in the markets for 43, 44 years. So he's been investing in stocks before the Sensex even began. I mean, even the data began before 1979. So whatever analysis or inferences I make from hours of data crunching, he knows by just living through the markets.
Yeah.
And he talks about risk. And many people today don't give him credit, but he was the one who was the first to say, put it in an index fund. Today we have all this index investing and that's all popular, but he was the one who first said, don't spend too much time worrying about which mutual fund to buy, just buy an index fund, you're done.
Okay.
So he's been a big influence on me, and also he had this audience primed to do DIY, ready to do DIY. And when he referred my blog at the early stages in 2012-13, so that audience, also started following me.
Okay.
So so PV Subramaniam is one influence. The other is inspirational person is Melvin Joseph. Melvin Joseph, he's a SEBI registered investment advisor. He's a fee only advisor working in Navi Mumbai. So he's one of the first in the country, and he had left a cushy insurance job and started out on his own doing this, and he helps people. He helps the common man.
Okay.
Many financial advisors work with only high net worth individuals, NRIs and so on. But he has placed his price at a level so low that anyone can access it.
Okay.
And he also helps children, impoverished children. He helps other people pay for their education and so on through an initiative called KEY, Kids Education and You.
Okay.
So more than 3,000 kids are being benefited by this. So he's a guy, because of his enterprise, he's also very compassionate, and he's also helped so many couples with their finances, and also widows and widowers with their term insurance claim.
Okay.
If there is any problem with a claim, if they go to him, he does it pro bono. All that is done pro bono. So he's a very inspirational person.
Wonderful, wonderful. Especially with the insurance claims, it's an ugly situation in India, unfortunately.
True. So that's one. And also anybody who works without expectations inspire me. For example, I have at home the caretaker of my mother. Yeah. She works very hard. She's very sincere, and she works without expectation. Yeah. And that's always something that drives me. That's said in our scriptures in Gita. Yeah. Yeah. You work, don't expect rewards. When you expect rewards, that's when all the problems start.
True, true.
So that's what inspires.
Wonderful. So this is a very simple and straightforward question. What do you think is more important, saving, investing, or earning?
I would say life has taught me that earning is the key.
Okay.
First you earn, because if you don't earn, you can't invest or save.
Yeah.
But just don't spend too much. Okay. Then only you can do both. Because saving and investing, you should know when to save and when to invest. You save for short-term goals and invest for long-term goals. You take on market risk. So that's fine. But earning is the key. So I would say young earners should focus on their skills, and they should focus on trying to increase their income over the long term. The problem with young people is, there's always been a problem with young people. I've had problems when I was young. That's just a generational thing. But they just want it fast. They want results too fast. Yeah. That's a problem. You don't get that with money.
True, true. Last night I got a message from my junior. He's 1 year junior to me, and he always sends me a screenshot of his mutual fund portfolio. And he says, why is it charging me expense ratio? I want to withdraw it. I asked him, why do you want to withdraw it? He said, it's been months, it is stable. I don't know it will ever go up. So please suggest me some other mutual fund. Then I wrote to him that that's not how mutual funds work. So now he's asking me, how do mutual funds work? And that brings your first point. People invest and then start to learn. That is a very big problem.
Today we have a serious problem because most people in the capital markets, either direct equity or equity mutual funds, they've all come in the last 3-4 years. Yeah. Almost 70% of them. Yeah. And they have all been influenced by the bull run that we have seen prior to March 2020, and then after, from April 2020 to October 2021. That's been their experience. They think that's how their future will always be. It will never be like that. The worst thing, a crash is not a problem. You don't have to worry about a crash, because a crash is like too many people believing that something bad is going to happen and pulling out money. Yeah. So at the same rate, they will come back in. Yeah. If the big crash will always be followed by a big recovery, but after the recovery, there will be a slowdown. Yeah. That happened in 2009 to 2013. That's happening now. Yeah. And that's the scary part, because you're losing time. Yeah. You lose 5-6 years of your time if you don't plan well. That time is lost forever. Because there are so many people who say, I want returns in 3 years, I want returns in 4 years. And they don't have asset allocation. All the money is in equity. Yeah. You don't do that for 3-4 years. It's just potluck. You will get any return you want. That's very dangerous. That's where the planning is not there.
So what would you advise people who are in this phase of investing when the market is moving sideways? it is going absolutely nowhere, and maybe it will stay like that for 2 or 3 more years. And that's what happened with you back in 2009 to 13. So what would you advise such people who have entered the market after 2020, let's say? Now they'll be disappointed like my friend is. So what do you suggest them they do?
I think first pause and look at your own needs.
Yeah.
So personal finance starts from us.
Yeah.
Why are you investing? When do you need the money? If you want the money in the next 5 years, 7 years, don't invest in any form of equity.
Okay.
Stick with ordinary FDs, RDs, that's fine. Nothing much is going to happen in 5 years. Have a long-term view. Invest money in equity only for your retirement, your financial independence, for 15 years, 20 years. Then you don't have to worry about what happens in the market in the next few years.
Yeah.
So you have to plan so that, and make sure you have enough money for short-term needs, and then put money away for long-term needs. That's what.
Yeah, but the concern most people have is they want to do something with that money after, let's say, 4 years. Now they'll come to you and come to anyone with some experience, and they'll ask them, I want to get my money back in 4 years. Tell me some mutual funds, yeah, tell me some stocks. When you suggest them that you should not go in equity, they'll say that how else can I collect that much money in 4 years? Then there's a bit of wrong planning on their part, right? So either you should increase your time duration or you should decrease your goal. You can't do both at the same time.
That's the problem. They are punching above their weight all the time.
Yeah.
It doesn't work. You have to lower your dreams and lower your standards of living, future standards of living, whatever, to do that.
You are a physicist. You used your mathematics and analytical skills to learn investing, and that's what you brought forward. You rely a lot on data. So how do you utilize that data to make your investing decisions? I mean, what are some discoveries that you made that other people cannot discover?
So I would say all this number crunching has taught me lessons about risk, about market risk. So people are always talking in the media about the market volatility is high now, market volatility is lower. It doesn't happen. If you actually look at the data and if you plot market volatility versus time, it will be a flat line.
Okay.
Market volatility is always constant.
Okay.
Whether it's 5 years, 3 years or 30 years, there's always been a constant. And one of the most important lessons I've learned is there is actually no proof that long-term investing in equity will work.
Okay.
All this power of compounding and stay invested, that's all fine, but there's no guarantee that it will work.
Yeah.
All it offers you is that there is a reasonable chance of beating inflation.
Okay.
That doesn't mean you will get the return you want.
Yeah.
People expect 15% return.
Yeah.
That is not the job of the equity market. The past tells us that whatever is the current inflation, the equity can offer us premium above that.
Yeah.
But that is very different from your return expectation. So equity can give you 9%, and if you expected 15, 12% and invested less, then you will not have enough money.
Yeah.
So that's where we must learn that when they actually tell you in the disclaimer that the past performance is not representative of future performance, they mean it. So the mutual fund industry actually means what they say in small font. Yeah. They don't mean that much what they say in large font. So you should revert our way of thinking. Yeah. But so those are lessons that I've learned from looking at past data. But that doesn't mean you should stay away from equity. People always take extreme reactions. When I say this, they say, oh, there are no guarantees, then why should I invest?
Yeah.
Then I ask them, where is the guarantee that you will be, you'll stay married? When you marry, there's no guarantee your marriage will work.
Yeah.
When you join a course, there's no guarantee that you will pass it.
Yeah.
There's no guarantee you will, get a job you want. So why are you asking guarantees in investing? There are no guarantees in anything you do.
True.
So that's true for investing as well. But there is enough data to tell you that the risks are reasonable and manageable. That is all you want. The risk should not be so high that you cannot manage it.
Yeah.
So as long as you give enough time, you can manage the risk with equity investing. And that's why people say stay invested for long term and so on. That doesn't mean you should have rosy ideas of, the graph moving up like that's nice and smooth and so on. So, and the other thing I've learned is about sequence of returns. That is, the same fund, you start an SIP in January, I start an SIP in July.
Yeah.
He starts an SIP in December.
Yeah.
we compare notes after 3 years, after 5 years, our experiences can be very different. True. Your return can be positive, mine can be negative, it can be very, very high. So that's the sequence of returns. It's also called timing luck in the market. So when you start and when you end depends on what path the NAV follows for you and me. So it's very, very different. So we'll have to combat that. How do you combat it? Just like you can't take your marriage for granted and you have to work on your relationship. You have to work on your portfolio. True. People are always in this LIC mode. Because when you start an LIC policy, you know that you're going to pay premium for the next 15 years. So people say, tell me which mutual fund can I start an SIP for 15 years? No, it doesn't work like that. It's not going to be the same mutual fund. That is where the index investing makes a difference. If you want to do all these gymnastics, then you will have to be either ready to shuffle mutual funds, actively manage your portfolio, or stick with simple index funds, you're done. You don't need to worry about fund management risks. So these are some of the lessons that life and numbers have taught me.
So speaking of guarantee, a lot of people my father's age, people maybe your age, who have seen the government job era, the job security era, today that thing is almost negligible. So it's okay to hear the guarantee word from those people because they have lived the guarantee wala life, and they've invested in LIC policies that comes with a sovereign guarantee. Government bonds also come with a sovereign guarantee. But do you think it's strange that when we hear the word guarantee from youngsters?
Oh yes, it's sad to see that people still want it. See, the problem is many of us don't understand basic economics. People say that in the 1990s PPF was 12%, 14%. You would get LIC annuities for 13% and so on. But that happened because the government was nearly bankrupt. The government became bankrupt in the early 90s. And unfortunately, in the debt markets, the more bankrupt you are, the more interest people will demand from you. When you cannot pay more, they will want you to pay. They will want higher interest rates. And that's how it was until the 90s, and then the 2000s things changed. So India has gradually shed its communist policies, and it has become more and more capitalist. Whether it's good or not is another matter. It's debatable. But what it means is that all our investments have become market linked now. Whether it's PPF, VPF, gilt trades, everything has become market linked, and if you look at the long term, it's actually fallen down. Yes, today interest rates are increasing, RBI, the repo rate is increasing, but that's not going to be there for it's going to increase, but it's going to
the trend is down.
Going to be down. So we have to prepare for that. And youngsters should not look at what their parents did or what their grandparents did. That's a different era. And most importantly, it's not about returns. Their lifestyle was much more subdued. Today, everybody wants to live it up. Whatever their income, they want to live it up. They say, and social media, they look at all these images of, oh, this guy has gone for a holiday in Thailand, I will go further. And Australia, I'll go Australia and beat him. And that kind of mentality is there. The spending is too much. That is the problem. And if you accompany that with the want of guaranteed returns, it's a recipe for disaster.
True. So, speaking of government bonds and things that do come with a guarantee these days, do you think that guarantee still means something? I mean, what if LIC goes bankrupt? So, will the government be able to pay off everything?
It's very unlikely that that's why I said there are risks and there are reasonable risks. Buying an LIC annuity, if I need it, that's key. If I need it, there's no problem. In fact, I have an NPS and I will have to buy an annuity when I retire. So I'll probably use LIC, assuming it will still be around at that time. And I think that's a reasonable risk to take, because that's like they say, there are institutions which are too big to fail. LIC is too big to fail. SBI, HDFC, ICICI, those are all institutions which are too big to fail. So that's a reasonable risk to manage. But
but what I am hinting is when people say I am buying LIC because it has a sovereign guarantee.
You should. That is fine. That argument is fine. But are you buying it because you need it? That is the problem. See, I can buy an LIC policy after retirement for annuity to get a pension. That's no problem there. I would prefer that instead of a private insurer for an annuity. But I should not buy it when I'm young and say I'm getting guaranteed returns and buy a policy and mix my insurance and investing before retirement. That's bad.
True.
So it's a question. The problem is people are emotional about the wrong things. You should be emotional about the right things. For that, you need little bit data. You should look at, all you need to do is look at how your lifestyle has changed over the past 5 years.
True.
Some tracking of, bare tracking of expenses if you do, you can see that all our lifestyles have increased at about 8 to 10%. At the rate of expenses have increased. Most of it has come from lifestyle creep, lifestyle changes. And not just because of the dal chawal increase in inflation and so on. That is okay. That is about 6% or so, roughly, approximately, because of fuel costs. But that's what we need to be looking at. We need to. My lifestyle is changing. Can I get rid of my smartphone just because I've retired? Can I get rid of my cable connection, my OTT platforms just because I've retired? Then that will be a failure, right? I mean, in terms of planning. So we have to maintain our lifestyle. Or the other thing is, don't think twice before spending, and don't enhance your lifestyle just for the sake of it. So then it's a question of need. Then it doesn't matter whether you're looking for guarantee or capital market linked risk and so on.
You made a very good point about lifestyle inflation. People, when people see the data in the news, the inflation, the new number is 7.1%. People think, okay, our mutual fund is capable of giving 12+%. But the formula that builds the inflation number consists of 3 major ingredients: the fuel cost, clothing, and food. All 3 are rising at 12%. So people plan with 7%, keeping in mind 7% inflation, but in reality, majority of their expenses are being raised by 12% every year. So we have to at least expect 12%, and that will only come when we reconsider our needs, lower our expectations, and manage our risk.
True. True. The thing is that 19 people want to do freelancing. They want to do that's a good thing. Very nice to see.
But when it comes to investing, I believe when a youngster, 18 or 20-year-old wants to invest, they are for the wrong reasons. They can be for the wrong reasons. One reason could be, I'll generate this much return, and then I'll feel good about myself. So that will ultimately land you in losses.
True.
So because a sense of maturity has yet to be developed.
True. The same thing is that's how I see trading as well. Many people get into trading and they do it because they want to get rich quick. It never works like that. Trading is a lifetime job. You have to learn the markets. The markets teach you about its risks. The risk in day-to-day trading is very, very different from the long-term investing risk, because the dynamics are very different. So it takes a lifetime to learn it. And if you ask any big trader, they will tell you, I have lost most of my money at some point in time. I've recovered, but I did lose it. So you're going to have to bear those big losses, and then go through that evolution. But people they see all these Facebook ads about passive income from stock market trading. I don't know how that works. The only person who makes passive income is the guy who sells the course. So that is very dangerous. Because it's not going to change your social station. It's just going to give you some spending money here and there to do something extra. I think that is wrong. I think young people should have a long-term view. Like Jeff Bezos says, look at your life over 30 years, 40 years, and think of where you want to be and work towards that. Don't think about the next 1 year. That's not how wealth is made.
I just remembered a great example. When I was little, and whenever I used to go out and see there's a bridge being built or there's a shopping mall being built, I used to ask my parents, or I used to ask myself that, okay, in 2 months if I come here again, I should see this fully functional. And then I would get disappointed that it's still the same, it looks still the same, the road hasn't been built, the building hasn't risen. And then I realized that, okay, big things do take time. They will not be built overnight. But I suddenly remembered, because that kept my expectations in check. So whenever there's a new government project around my neighborhood, I tell myself, okay, this is not for me. Maybe this is for my kids.
True, that's a good example. Yes. So regarding the inflation that you asked me, so the thing is that our day-to-day expenses, the inflation is about 7-8% maybe. But the danger is that many services in India are not regulated. Hospital expenses in India are not regulated at all. They can be anything. Same with the school fees and so on. So these are increasing at the rate of 10%, 12%, 14%. So there's a point beyond which you can't expect too much return. You can't expect to beat 14% inflation.
Yeah.
If you're lucky, you can, but that's not going to be the risks associated is no longer reasonable for that. So there you have to compensate by investing more.
Yeah.
That's something that what happens is financial advisors are scared to tell that to clients. Invest more because they're scared they'll run away.
Yeah.
So we need to invest as much as possible, and that the only way we can do is balance our spending today, and so that we can fund our needs for tomorrow.
Okay, so you have a good investing experience. What are some examples of your best and worst investments?
I don't think I have a best investment yet. See, my life is not fluctuated like that. It's been more or less, I always looked at my needs and invested. Probably I would say that if I had to do it all over again, I'd probably get rid of my active funds and replace them all with an index fund.
Okay.
The biggest reason is that if something happens to me today, my wife can just take over that without worrying about which fund manager is doing better, which active fund is doing better, and any advisor can look at that portfolio and continue that without so the investments will not be disturbed.
Yeah.
It can just continue across and beyond me. That is one. And also for me today my wealth has grown a little bit, so I don't care about which fund works, 3-star, 4-star, I don't care.
Yeah.
But the simple choice which I keep telling to young people, but they keep asking me, why don't you invest in active funds? I mean, why are you investing in active funds? Why are you not investing in passive funds? The reason is my portfolio has become so big that if I add a passive fund to it, it will be too small. It will not make any impact.
Yeah.
But I tell young people, don't make the mistakes I did.
Yeah.
I did the same mistakes that anybody does, looking at stars, looking at recent performance. That is the biggest mistake people do, and they look at the last 1 year, 1.5 year, 2 year performance, and then they put in money.
Yeah.
And after they put in money, the fund will drop. It's the law of averages. Yeah. You can't. It's a hot hand fallacy. You can't say that the first 5 balls have been hit for 4s, therefore the last ball will also be hit for a 4. Yeah. It never works like that. But that's the mistake. I have made those mistakes, and I like to think that. I could have done better.
True. So speaking of picking mutual funds, I saw one of your videos where you said just pick any mutual fund, don't go overboard, don't add too many funds in your portfolio, and you said pick a fund that is not so popular. Why is that?
See, it's like the quote from the Matrix where Agent Smith says that human beings are like viruses. They see something good and they go and herd on it, they accumulate and they destroy it, and then they move on to that. So when mutual fund investors see some good performing mutual fund that outperforms significantly, everybody goes there.
Yeah.
And then the AUM increases, the fund manager faces the heat, and he cannot be as nimble as before. He cannot change stocks, he cannot churn the portfolio, and then the performance drops. The same thing happened to Prashant Jain in 2009. After the Congress government got re-elected, the markets moved up.
Okay.
The markets reacted positively, and then there's a lot of inflow into his 2 funds, HDFC Equity and HDFC Top 200 at that time, those were the names. And the churn rate, the ability in which he was churning the stocks, it dramatically dropped. Okay. And those mutual funds became more and more large cap oriented. Okay. Because that's the only way he could maintain liquidity and handle the portfolio. So that's why I said stay away from popular fund managers and popular mutual funds, so that you are in a space where it's not, nobody gets the fund doesn't get noticed, so you can happily invest. That was how Parakparik FlexiCap was.
Yeah.
And when I started investing it as an NFO, and I thought, okay, this doesn't have a banking channel to push the fund, so it will remain quiet for some time. But in the last few years, it has tremendously grown. But now again, people are complaining, they are not investing enough in Google, Facebook, it's going down. So they have a short fuse in terms of expectations. They just wanted to.
So my junior who was asking me about the fund that is not performing, that was Parag Parikh fund. So
I'm happy. I'm happy if people move away from it.
Yeah. So speaking about unpopular and popular mutual funds, there's also a point to be considered that if a fund becomes too big, people say that its ability to generate returns gets hindered. do you think it's true? If yes, then how should we invest in one mutual fund for a very long term? So if that fund becomes too big, what should we do?
I mean, it's very hard to prove it. I've tried to prove it. It's very difficult to make a meaningful study to say that this, because of the AUM increase, only the returns came down. That's not possible, because even today there are funds, for example, HDFC has a mid-cap fund which has got a very large amount of AUM, I forget the name, but it's doing well. It's not a stellar performer, but it's doing quite well. So it's very hard to prove it. But it's just a matter of, see, the problem is there are phases when all the mutual funds fall down. Then many people ask, why is my mutual fund alone falling down? No, it's not your fund alone.
Yeah.
The whole market is falling, so everything will fall. That is okay. But if there are some reasons where only your fund is falling, then you should get rid of it. So there are two choices. One, be an active investor, and be ready to switch funds every 3-4 years, because average it will keep moving up and down. Today there will be 5-star, tomorrow it will drop down, become 5-star again, back down, and so on. You should be ready to switch or go through periods of underperformance if you have the faith.
Okay.
Very few people have that anyway. Or simply be an index investor.
Yeah.
Be happy. Just forget about it. You get some return very close to the index and you're happy. And I think if the index is, if we assume that the index is going to move up over the long term comfortably, then all the funds, even our average performer, would do well.
Yeah.
So that's why I said don't worry too much about which fund you pick. Because it's not going to be the fund you're going to, this is not a marriage.
Yeah.
I mean, it's an acquaintance at best, and you're going to change acquaintances. For that, you need to be professional about looking at portfolio management. The problem I see is that most people don't want to learn portfolio management.
Yeah.
They don't want to look at it from the top. So you should look at your need, you should look at your target corpus, you should look at your asset allocation, then you should look at the assets, and only then at the fund performance.
Yeah.
People do the other way around.
Yeah.
But they don't go beyond fund performance.
Yeah.
That is the problem.
Okay. So speaking of the new investors, and considering the fact that more than 90-95% of Indians don't have enough money to invest, what would you suggest them? How many mutual funds should they invest into?
I would say just one is enough. Just any Sensex or Nifty, not any. I would say the ones with a reasonably low tracking error. That is the one thing. They should be looking at trying to increase income. If the income increases, everything is fine. In fact, I have seen this in my life, and advisor Sapnil Kende has also made this point. That is, let's say two people start. One guy starts earning right after B, let's say 22.
Yeah.
And the other guy studies, he does other, higher education, qualifies, just like what I did, what I went through. The other guy only starts at 35 or 32. The salaries will be very different.
Yeah.
The guy who starts late will have a much better salary.
Yeah.
And he can actually make up for the time lost.
Yeah.
So I would say focus on trying to get your skills up. Make sure you're always employable. You should be constantly employable. Either you should know how to do it on your own, be an entrepreneur, or you should be in demand. If that is okay, then you can spend some time without investing, focusing on increasing your income. You can always make up for it later.
Okay.
But if you say this much is enough, I'm not going to study further, then that would severely limit your ability to build wealth over the long term.
Okay. So just one fund is enough, but the focus should be on increasing your income. And when you have enough money, then you can, maybe think about adding a fund. But
no, you can always make up for the lost time. That's what I mean. The point is, people want to, FOMO is a big problem. If you look at all financial ads, FOMO will be there. Have you invested in this? Have you not done this? They will always try to push that FOMO button. That is what we have to control. You should tell yourself, I am invested in the Nifty index. I don't need to look beyond that. I'm fine. I don't need a mid cap. I don't need a small cap. They don't matter. Nifty is good enough. That control is the huge thing. Because my friend is doing trading, I don't need to do it.
Yeah.
That control and that maturity is the biggest problem.
Yeah, just reminded me of what Mr. Rakesh Jhunjhunwala said during his last years. Someone asked him, why don't you invest in crypto? He said, I don't have to go to every party. So
precisely.
Yeah.
Precisely. That's a wonderful saying.
So you are a physicist. I can't even imagine what it's like to become one. You have a job, full-time job at IIT Madras. and now you are into investing. You make content around investing, and which is very useful. How do you manage both of these?
It has been a very uneven ride for me. It's not been normal in the sense that 10 years ago I started this website in May 2012. A few months after that, I was down with an autoimmune condition. For the next 1 year, I was almost bedridden. I couldn't do much. I couldn't teach. I couldn't go to work and so on. So learning about finance was one way for me to get out of that funk. I was in a very bad state of mind. I thought this is how my life is going to be. So it kept me occupied, something to think about.
Yeah.
But then after that, I used to work on these calculators whenever I had time. We have summer vacations, winter vacations, and so on. So most of the content was made around that time and scheduled later on.
Yeah.
So over the last few years, I've learned the power of delegation now. I realize that I'm becoming old. I cannot, keep up at the same pace. So now I have a team of people who wish to be anonymous. There are people working in all the big tech companies all around the world, and they help me manage my site, and they also produce content now. Most of them are anonymous. Some of them they prefer their names. They produce some products and so on. So they maintain the site. So I've learned to delegate it, and I'm looking forward to do something else now.
Yeah.
I'm trying to, because if you look at my life, I've done all the things that a physicist should not do. I have worked in one area of physics, then stopped working on it and done something completely different.
Yeah.
Then after a few years, done something else. Yeah. So I would like to move on to something beyond finance and do something else. I don't know what that is. I'm still waiting for what that calling is. But I'm hoping that's it, and I've delegated it, and I want to, I'm shedding my role as in FreeFinCal gradually.
Okay. So, matlab, if I were to put it, you are at the completion stage of a current phase. See, you've learned physics, you've learned investing, now you want to do something else.
See, the thing I would say that completion meaning that I would like to do new things in the sense that I have covered the basics.
Yeah.
And if I do it again, it will just be saying the same thing over and over. And that repetition can be done by anybody. I can delegate it to somebody. What I would at the moment like to do is to study more about market risks.
Okay.
It would not be immediately useful for day-to-day investing or investing in mutual funds, whatever. But I want to study the nature of the market risk. How is it linked to chaos? How is it linked to fractals? Okay. What can we do? Can we learn something useful from it?
Okay.
That is something that the problem is that doesn't translate well into content.
Yeah.
Because very few people will read it.
Yeah, that's what happens with science and research. It takes years and years for someone to finally find some conclusion that can be conveyed to the world. But it's necessary. If nobody will do it, then we are going nowhere.
So those things will take computations, and it will take, I have to set the computer and it will take weeks to finish. Yeah. So I would rather do that privately and publish separately. Okay. Rather than on FreeFinCal.
Okay.
That's my plan.
So we got the sneak peek into what you are planning for yourself in the future. So you teach some of the smartest kids in this country at IIT Madras. Do you think they also make some investing mistakes, and are those mistakes similar to a common man's investing mistakes?
First of all, I don't think the kids in IIT are smart. It is just that those kids have taken a decision to sacrifice their time and effort much more and much earlier than other people in the country.
Yeah.
Whether it comes to working for JEE or any other entrance exam related to IIT or in IIT. So they're not smart. It's just that they spent so much time that they've accumulated some knowledge. It looks like they're smart. It's like what you have done. If you do video editing alone and nothing else, after 6 months you're an expert.
Yeah.
So that's how those kids are. Yeah. But other than that, they're as normal, as fallible as anybody else. Okay. They make the same mistakes or don't make the mistakes as anybody else. I don't see any difference.
Okay.
What I see today is that, like I mentioned to you earlier, young people are more interested in investing right.
Yeah.
They don't want to invest the way that like their parents did. Of course, there are many people who are still influenced by their parents, but the number of people who want to do it right, do it independently, have also increased. So they're searching for content, and that's how I I knew that what I do at FreeFinCal will eventually work. I knew that initially there are many years where nothing happened. Nobody noticed FreeFinCal. But eventually, thanks to Google's machine learning has improved so much, and you don't have that kind of usual keyword stuffing, that kind of SEO doesn't work. I've been the biggest beneficiary of it, and I've been able to cater to these kids who are looking for it.
So that's great. I mean, one very important point that I'd like to discuss. I haven't had the chance to discuss in detail with any other expert yet. Do you think our expectations of wedding and our expenses on wedding will hold us back? Will not make us achieve retirement plans?
I think so. Yes, I think I'm scared. I'm scared to go to weddings these days, to be honest, because I see people are serving popcorn, there are candy flosses, there are drones flying.
Yeah.
I mean, I just cannot stomach it. There's too much, and I ask about the expenses. They say minimum 50 lakhs.
Yeah.
In certain circles, and that's a minimum. And they have these huge photo shoots and so on. Most of it, I would say, don't spend, because how much ever you spend, your relatives are always going to find something to complain about the wedding. It's always going to say this is bad, that's bad, you didn't do that well. Forget about that. If you have enough money, give it to the kids.
Yeah.
Let them start their career or start their family life in a solid financial basis, and say spend it well, instead of. But that's life. I mean, you're always going to have these pressures, and it's infectious. I overheard a conversation in IIT some years back. It was a very trivial thing. One guy said that guy had 2 desserts in his daughter's reception. So in my daughter's reception, I'm going to have 3 desserts. That's how it's a very trivial thing, but that's how people think. They want to outdo for no reason. That's not a goal. Nobody cares, right? So yes, it's going to be a problem. What is going to be a problem is that people want to change their social station the wrong way.
Yeah.
They're only earning this much, but they want to spend that much. Although they don't, they want to spend that much, and they borrow. But if you want to change your social station, you should do that by taking risks with your career. The reasonable risk, the right amount of risks, and you should hold back your spending, and even if you want to work somewhere as an intern without pay, you should be ready to do that. But people don't want that. They get the bonus, it's gone. And I go to these corporate meets and I ask them, when does your money run out? So I usually hear some people say 20th. 20th is very good these days. It's a record. Okay. So, if I go up north, it becomes worse. Some people said, one guy said 3rd. He said, I get my salary on the 1st, I run out of money on the 3rd. I said, what are you doing? How are you manage it? That's how it is. The spending has become too much. Everybody wants to change their social station by spending. That's never going to happen. You're going to go down. That's the biggest problem we have.
So the reason I ask is because I see a lot of people, borrowing money, 20 lakhs, 30 lakhs, just to facilitate their wedding, just to show that they can, or three desserts and all. Then the point that you made about kids, that people, the people who are spending 20-30 lakhs on marriage after borrowing money will again struggle to raise their children. And then okay, it's one thing to spend a lot of money on wedding, then at least people should understand we are not ready to have a kid yet, so we should first pay our debt. We should then start saving, because in 2-3 years we'll have to send them school. So that whole planning is so messed up, and sometimes I feel that why is it so difficult to understand? To me it feels fairly simple to say that okay, if I spend money I will not have money, but it's at the same time very difficult for people to understand.
Yes, it's a big deal, and if you have 2 children, I think it's very difficult. I often say that inflation should be the best contraceptive. 1 kid manageable, 2 kids you're almost screwed. 3, because if second becomes twins, you're done for. That happens. Like what you said, if you borrow and for a wedding, you're going to spend the next 5-6 years repaying that debt. So you're scared about starting a family. By the time you become old, you can't, natural childbirth is gone. You have all these fertility clinics everywhere now. If you go via the fertility clinic, minimum is twins. You never get one. Very rare. If you get twins and to start with, your life is sealed. That's it. You can forget about, you have to work until 60, 70. So that's where these things matter. They will pile up. That's the real power of compounding, I would say. Negative compounding, you should say. Yes, you should. That's why I keep telling people, don't do anything. Spend 1 hour doing nothing every day.
Yeah.
Put all your gadgets away. Maybe go for a walk, do some meditation, but think about your life. What is it I want to do? Think about all the nightmares that can occur to you. It's very easy to dream. Dream, forget it, you will get it. But think about all the bad things that can happen to you. And how are you fighting for those bad things? For example, we had a PhD student a few years back in the department. He went trekking. He lost his footing and fell to death. His parents were farmers. They had no money. This guy was the only one spending for his expenses and giving them money from his stipend.
Yeah.
And what would they do? So those are the things those are the risks we need to think about. What would happen? So I say that even if you are young and not married, doesn't mean you don't need a term insurance policy. You should look for your parents. Are your parents financially independent? Buy a term insurance policy, put your parents as nominee. They'll get something.
Yeah.
So that happens only when you think about yourself. I'm not saying be selfish, but think about all the bad things that can happen to you and how you can fight it. But we are always thinking about what the other guy is doing, how much return you get here, how much. So we are being distracted by too much information.
And I feel thinking about bad things is not very well received in the community. If you tell your friends, okay, last night I thought, what if I died? So people, your parents, friends, everyone will tell you, why do you always think bad things? But I think there's a fine line between, rationally, imagining situations that are very much possible and overthinking.
Correct.
So I don't call this overthinking, and I do this myself. Maybe not 1 hour, maybe more than 1 hour, because that's what my personality has become. But I always keep imagining the worst case scenarios. What if this could happen? What if that could happen? Yeah, but it's such a burden sometimes. But I still don't call it overthinking.
No, it's overthinking when you don't do anything, when it paralyzes you. Negative thoughts should force you into action. Whatever thoughts should force you into action. You should do something to, as an arrangement to fix that risk. Then you are fine.
True.
That's
currently mine is 50-50. I take 50% action. But yeah, it's very important to think about those things, and people don't do it. So any last piece of advice that you want to give to our viewers?
One lesson life has taught me is don't give advice even if somebody asks for it. The reason is I always believe that we are all victims of our experiences. My lessons in life are based on my journey. And just like SIP started on different dates, can have different returns. All of us are different. Tom Cruise said something wonderful. He said, I have never seen a normal human being. Everybody has a story, and everybody's story is different. So whatever advice I would give, assuming that the mistakes that I made will be the mistakes you make or anybody else make, it's always very dangerous. So the one thing that I've learned is that we should be ready to course correct at any point in time. There are no set plans. If things change, we change. If the data changes, the opinion changes. But don't change opinions before the data. So we should be ready to be flexible. That's all I can say.
Okay, thank you so much. Lastly, for people who are building their retirement plans, let's say my goal is 20 years away. What would you suggest them? Because if I were to retire today, and today is, let's say, 2008 subprime crisis, my retirement would be screwed. So what do you suggest? How do they navigate that?
Yeah, there are a couple of ways to do it. The first thing is to invest as much as possible. Like I always say, I don't know if I can say it, like invest like your ass is on fire. At all times. So accumulate as much as possible, and decide on what your asset allocation is going to be after retirement, years before retirement. So when I started out, I always thought that 60% equity is too much for me. But because my net worth has grown, today I'm comfortable with 60% equity, and now I want to have 60% equity throughout my life.
Okay.
That means that 40% fixed income should be enough
Right.
to handle most of my needs in retirement. So things change. Like I said, you have to adapt. But for that, you need to plan. You must be ready to have, my thumb rule is at least for first 15 years in retirement, you should have enough fixed income assets to get inflation protected income.
Okay.
If you do that, then you can handle those kind of negative market returns, sideways markets and so on, at least for 15 years. But then you'll have to manage the rest of the portfolio actively. So one important point is the way Indians are managing retirement money is dramatically shifting. So our parents' generation, 100% fixed income, fixed deposits, small savings schemes, annuities and so on. Now that's changing to little bit into mutual funds, debt mutual funds. So more and more my generation will be having a proper bucket strategy with very little dependence on pension. Your generation will be even more. So we don't have the necessary expertise to cater to that.
Right.
We also don't have the market history to understand risks.
Yeah.
So it's a very dangerous situation to be in. So we should safeguard as much as possible with fixed income assets, but also have some equity capital, let's say 20 to 30%, not more than that, to handle inflationary increases in retirement. Okay. So it's a very tricky situation.
Yeah. So one important point that you made, retirement planning has been dramatically shifting. So people earlier would invest in LIC policies, and they had fixed job security, everything. Even today, if you look at our parents, I mean my parents and my parents of my friends and family, they would, the go-to investment that they would pick is either real estate or anything FD or something like that. But even then, if they want to invest in mutual funds, they would go 100% in equity. So why do you think is that?
I think that's the advice they get.
Yeah.
Is the problem, because the people in that generation, they want to ask advice to people. If you ask advice, you're always going to be sold a bad mutual fund most of the times, and you're all that's where they need to do a little bit of research, or you need to work with a SEBI registered investment advisor who's fee only without any conflict of interest. But many people are not willing to do that. They don't want to spend that money for advice and do that. So it's a tricky situation which requires some thought. And my problem is, it's okay if the guy has got a lot of assets elsewhere.
Yeah.
And 100% equity being the only fund is okay as long as it's a small portion of the portfolio.
Yeah.
What is now happening is that is increasing alarmingly. It's a changing phase as we speak. Yeah. And more and more assets are going to be in mutual funds after retirement. Yeah. And that's going to be difficult managing, because if you have these sudden shocks, either a crash or a series of negative returns, the retiree is going to be in trouble. So that requires careful planning.
True. Thank you so much, sir,
Thank you. Pleasure is mine.
Agreeing to do this. And I hope you have a good investing research ahead.
Thank you so much.
Thank you so much.
Wish you all the best.
I hope you got to learn a lot from this episode. It is time that I ask you for a favor. Do share this episode in your friends and family WhatsApp groups. And after you've done it, come back here and write it in the comments that you've shared this episode. I'll personally respond and appreciate your effort. Also, download CRED app from the link given in the description and in the top comment. Use CRED app to pay all your utility and credit card bills. You will earn CRED coins in return, which you can then use to get huge discounts on your favorite products. Trust me, they are discounts like you've never seen. I like CRED app because it encourages you to be disciplined, to pay your bills on time, and it rewards you to do the same. So make sure you download CRED and share this episode. I'll see you in the 6th episode of Jagruk Talks Season 2 powered by CRED. Bye bye.
चले हैं हम वापस, पॉडकास्ट हो गया है, अब बस एक ही काम बाकी है, बहुत इम्पोर्टेंट है, जाके 1200 घंटे सोना है। अरे रोहन यार, मेरी अजवाइन तो रख ले अपने बैग में यार, गैस हो जाती है यार।